Happy Friday and happy Labor Day weekend. I hope you have a fun weekend planned. So today is Friday, September 1st, 2023. And last week I was reading an article in the Denver Business Journal with the headline, Why Retirement Dreams Could Become a Nightmare for Gen X. Now, Gen X, the demographic, in general, born between the mid-60s and the very early 80s, of which I happen to be a member of this demographic on the southern end of that age scale. But a couple of key points that came from this article that I want to talk about. Retirement is something I've been thinking about a lot of in the past couple of years. Now, right now, I'm approaching my mid-40s. But the article was saying, as of right now, and I believe this is nationwide, that 40% of this demographic does not have any retirement savings, which that's a huge percentage. The typical household, as of right now, nationwide, has about $40,000 saved up. And, the article talked about this generation has seen multiple economic hardships over the course of their lives. I remember very distinctly between 2008 and 2010, I got into real estate in 2004. So 2008 to 2010, myself and a couple of other investors that I worked with at that time, we were buying fix and flips, not so much rental properties back then, but, buying a lot of fix and flips, a lot of foreclosures. There was a lot of inventory in Denver at that time. I remember, during those days, for example, in 2009, at some point in time, there were over 31,000 properties for sale in the Denver metro area. To put that into context, right now in the Denver metro area, there's about 7,000. And Denver's population right now is probably 500,000 people more than there was back then. So, the inventory game is an interesting game, but I remember there were areas of the city where we were measuring inventory in years, not in months. Right now, we're measuring inventory sometimes in weeks, not even months, or maybe very low months. Maybe some neighborhoods have less than 2 months of inventory, a month and a half. That's not a lot, compared to if you were a neighborhood back then in 2008, 2009, 2010 that had a year of inventory, or two, or a year and a half, for example. So anyway, sorry to digress slightly. But the point I wanted to make behind this was, back then, there were a lot of foreclosures, there were a lot of short sales. Sometimes you could get deals at 70 cents on the dollar. If you were targeting foreclosures and short sales, for example, and trying to do fix and flips. There weren't a lot of buyers on the flip end. Like if you were an investor buying a property, gutting it down to the studs, refinishing it, and then trying to resell it in a, let's say, 3 to 6 month time frame. So you had to be very aggressive on your, or aggressive from a conservative standpoint in your list price just to try to get it sold, because the longer you sit on it, the more your costs are and things like that. But after that, like myself and several investors, between 2012 and 2018, 19, started buying a bunch of rental properties. And I was looking at one rental property actually earlier this morning in a neighborhood in Southeast Denver. It's a little 2-bedroom condo, under $300,000. It's under just shy of 1,000 square feet. For example, 2-bed, 2-bath. And I was looking at this condo because, this Denver Business Journal article was talking about even married Gen Xers. Right now, over half of married Gen Xers don't even have 10% of their retirement savings goal, which made me think a year ago, there was a Wall Street Journal article that talked about what a $2 million retirement in the United States looks like these days. And obviously the past couple of years, we've seen inflation, and interest rates rise and things like that, maybe some retirees have a house that they own that is fully paid off now. Some do not. This Wall Street Journal article talked about that, but they interviewed 4 people ranging in age between 60s and 80s who lived in different parts of the country. And we're talking about showing here's what a $2 million retirement looks like. Now, one of the things this Denver Business Journal article talked about was Gen Xers, depending upon their workplace, a decent amount of their workplaces don't have pensions or 401ks. Some do, obviously, but not all of them. So it's whether you have a pension or a 401k or a Roth IRA or whatever it may be or not, real estate can be a very strategic angle for retirement. So going back to this condo that I was looking at, for example, if you were to buy this right now, and let's say you put 20% down, interest rates are higher right now. Interest rates on an investment property are pushing almost 8%, which is very high. But the average rent on this condo is $2,150 per month. Now, if you put 20% down, and then you factor in all of the monthly expenses, your mortgage, taxes, insurance, HOA, you do need to have a maintenance budget if you're gonna consider buying rental properties or things of that nature. Starting off, your monthly expenses would be about $2,250 per month. So you would be, give or take, $100 per month cash flow negative. And if you want to, I have all my notes and numbers. If you want me to share these with you, don't hesitate to ask, and I will send you all the stuff that I have. But anyway, so you would be, give or take, $100 per month cash flow negative. Now, investment real estate does have a lot of tax benefits that I can get into you and share with you if you want me to share, my numbers that I have. The tax benefits are factored into all of these equations that I run. But anyway, so going back to it, if you decided, okay, what if I bought this, held it for 10 years, but let's say after year 1 and year 2, your interest rates dropped and you refinance to a lower rate 2 years from now. Let's say maybe it's 1% lower. Well, then you would go, and also factoring in the assumption, if you raise rents 2% per year, which historically Denver has averaged long-term 3 to 4 percentage points per year. And if you also factored in average annual appreciation of your asset of 6% per year, which for the record, the 45-year average for appreciation in the Denver metro area is 6.5%. But anyway, if you factored in these things, you would start off, the first 2 years would be cash flow negative, give or take $100 a month. So if you factor that in, you're talking about $2,400 over the course of 2 years. Now, you do get some tax write-offs with that, in addition to the interest that you're paying on the loan, any maintenance, property taxes, insurance, other costs. That could be, for example, give or take $15,000 to $20,000 a year, which is significant. But anyway, if you factored some of these variables, 2% rent increase per year over the course of 10 years, 6% property appreciation over 10 years, your mortgage is getting paid down over the course of these 10 years. Well, it turns out with an investment, with your down payment money, you do have, some closing costs to get a loan, to refinance, and some other costs over the years. But let's say over the course of 10 years, maybe you have $75,000, $80,000 in total costs, down payment, refinance costs, other things. Then you get your cash flow, you get your tax savings, which over the course of 10 years could be in the range of $175,000 to $200,000. And if your tax bracket is 30%, 35%, or 40%, well, do the math. Along with property appreciation and things of that nature, this could be an investment where $75,000 could turn into $325,000 10 years later. And now part of that is tax savings that you would get off of your taxes over the course of those 10 years. But, just imagine if you found a way to, over the course of a decade, let's say you could buy 2 or 3 of these. Well, depending upon how you play your cards, that could be $1 million. That could be maybe even 1.5 over the course of 10, 15, 20 years. Obviously, there's a lot of things you cannot predict what is going to happen in 5 to 10 years. But real estate has always been a very strong asset against inflation, even historically, even better than the stock market. Now, I'm not saying if you have investments in the stock market, 401ks, IRAs, whatever it may be, to get rid of all of them. No, diversified portfolios are a good thing. But what I am saying is if you can look at building a plan, if you're trying to factor in for a retirement in 10 years or 15 years or 20 years, or maybe even it's longer than that. Obviously, the more time you have, the more you could build up. But you play this game the right way, even if you don't hold these assets for 10 years, maybe you only hold them for 5 or 7, but then you go, you sell, you make money, you reinvest that money into something else, whether it's real estate or not. There's plenty of tricks of the trade that you can go take that money to build it over time to, try to build up a couple of $1 million in a retirement nest egg for whenever those goals of yours could be. So anyway, I hope you have a very happy Labor Day weekend. If you have any questions about any of my notes on this, or about your zip code or your city or your neighborhood, or any other thoughts that you have, real estate can be a very powerful tool to maybe try to get you to some of these goals that this article was talking about. So anyway, take care.